Hey everyone, it's your name and let's be real, nobody wants to work forever. We all dream of reaching that glorious point where we can finally kick back, relax and enjoy the fruits of our labor. But achieving true financial freedom in retirement takes planning, and it starts with understanding your investment options. Today, we're diving into the world of retirement planning to compare two popular options, the 401k and the Roth IRA. Choosing the right retirement plan can make a huge difference in how much wealth you build over time. We're talking about potentially hundreds of thousands, even millions of dollars in differences. So, whether you're just starting your career or already thinking about your golden years, this video is for you. We'll break down the pros and cons of each plan to help you make the most informed and best decision for your financial future. Alright, let's start with the 401k. Now, if you're employed, chances are you've at least heard of this one. It's a retirement savings plan that's sponsored by your employer, and it's pretty much the bread and butter of retirement planning for many Americans. Here's how it works. You contribute a portion of your pre-tax income to your 401k account, and that money gets invested in a selection of mutual funds or other investment options offered by the plan. The beauty of this pre-tax contribution is that it lowers your taxable income, which means you get to keep more of your hard-earned cash right now. But here's where it gets really interesting. Many employers offer something called an employer match, which is essentially free money towards your retirement. It's like finding a golden ticket in your paycheck. Basically, your employer agrees to match a certain percentage of your contributions up to a specific limit. For example, they might match 50% of your contributions up to 6% of your salary. Let's say you make $60,000 a year. If you contribute 6%, which is $3,600 annually, your employer would kick in an extra $1,800. That's an instant 50% return on your investment before you even factor in any market gains. Trust me, you don't want to leave that kind of money on the table. Now, when it comes to withdrawing your money, there are some rules. You generally can't touch your 401k funds without penalty until you reach age 59 and a half. If you do withdraw early, you'll get hit with a 10% penalty on top of your usual income taxes. But hey, that's retirement we're talking about. The whole point is to let your money grow over time so you can enjoy it later in life. Plus, there are some exceptions to the early withdrawal penalty, like if you become disabled or need funds for certain medical expenses. One more thing to keep in mind with a 401k is something called vesting. Vesting refers to the ownership you have over the contributions made by your employer. Some companies have a vesting schedule, which means you gradually earn ownership of those matching funds over a certain period of time. For example, you might become 20% vested each year for 5 years. This just means you need to stick around for a while to get the full benefit of those sweet employer contributions. So to sum it up, the 401k is a fantastic way to start building a solid retirement nest egg, especially if your employer offers a generous matching program. It's like having a financial safety net that grows over time, giving you peace of mind knowing you're taking care of your future self. And remember, the earlier you start, the more time your money has to grow. Compound interest is a powerful thing, and starting early can make a huge difference in your retirement savings. So take advantage of that employer match, contribute as much as you can, and let your money work for you. Your future self will thank you. Now, let's move on to the Roth IRA, which stands for Roth Individual Retirement Account. This type of retirement account has become increasingly popular over the years, and for good reason. Unlike the 401k, which is tied to your employer, the Roth IRA is something you set up on your own, giving you more flexibility and control over your investments. This means you can choose from a wider range of investment options, including stocks, bonds, mutual funds, and even real estate in some cases. One of the biggest advantages of the Roth IRA is that your money grows tax-free. This means that all the interest, dividends, and capital gains that accumulate in your account over the years are not subject to federal income tax. That's right, you heard me correctly. Tax-free. This can make a significant difference in the amount of money you have available when you retire. With a traditional 401k, You get a tax break up front, but you'll have to pay taxes on your withdrawals in retirement. This can be a substantial amount, especially if your investments have performed well over the years. But with a Roth IRA, you contribute after-tax dollars, meaning you pay taxes on your contributions now. But when you retire and start taking distributions, those withdrawals are completely tax-free. This can provide a sense of financial security and peace of mind. Think of it this way. With a Roth IRA, you're essentially paying taxes on the seed, not the harvest. This analogy helps illustrate the long-term benefits of paying taxes up front. You're letting your money grow and compound without the IRS taking a cut later on. Over time, this can result in a significantly larger nest egg for your retirement. This can be a huge advantage, especially if you anticipate being in a higher tax bracket in retirement. By paying taxes now, you avoid the risk of higher tax rates in the future. Now, there are some limitations to the Roth IRA. It's important to be aware of these so you can plan accordingly. One of the main ones is the contribution limit, which is significantly lower than the 401k. This means you need to be strategic about how you allocate your retirement savings. For 2023, the maximum you can contribute to a Roth IRA is $6,500 or $7,500 if you're age 50 or older. This limit is set by the IRS and can change from year to year. This is much lower than the 401k contribution limit, which is $22,500 for 2023. Therefore, it's crucial to consider both types of accounts when planning your retirement strategy. Another thing to consider is your income. Your eligibility to contribute to a Roth IRA can be affected by how much you earn. The Roth IRA has income limitations, so if you earn above a certain amount, you may not be eligible to contribute to a Roth IRA. This is something to keep in mind as your income grows over the years. For 2023, if your modified adjusted gross income is $153,000 or more, as someone filing as single, married filing separately, or head of household, you can't contribute to a Roth IRA. These limits are also subject to change, so it's important to stay updated. For those who are married filing jointly or are qualifying widow-heirs, the limit is $228,000. These income limits can impact your retirement planning, so it's essential to be aware of them. But even if you can't contribute the full amount, it's still a good idea to contribute what you can. Every contribution, no matter how small, can add up over time. Remember, every little bit counts when it comes to building wealth. Consistent contributions, even if they are modest, can lead to significant growth over the years. One of the other great things about the Roth IRA is its flexibility. This flexibility can be particularly beneficial in times of financial need. Unlike the 401k, which generally penalizes you for withdrawing funds before age 59 and a half, the Roth IRA allows you to withdraw your contributions at any time without penalty. This can provide a valuable safety net in case of emergencies. This is because you've already paid taxes on those contributions. Therefore, you have more flexibility in managing your finances. However, it's important to note that while you can withdraw your contributions tax-free and penalty-free at any time, the same doesn't apply to any earnings you've made in your Roth IRA. These earnings are subject to different rules. Those earnings are subject to taxes and penalties if you withdraw them before age 59 and a half, unless you meet certain exceptions. It's crucial to understand these rules to avoid unexpected penalties. So, to recap, the Roth IRA is a fantastic option for those who want tax-free withdrawals in retirement and prefer more control over their investments. It offers numerous benefits that can help you achieve your financial goals. It's especially beneficial for younger investors who are in a lower tax bracket now and expect to be in a higher tax bracket later on. Starting early can maximize the benefits of tax-free growth and compound interest. So, there you have it. The 401k and the Roth IRA, two powerful tools in your retirement planning arsenal. Each has its unique benefits and can play a crucial role in securing your financial future. The 401k offers the advantage of employer matching contributions and pre-tax contributions, which can significantly lower your tax bill today. This means more of your money is working for you right now. On the other hand, The Roth IRA shines with its tax-free withdrawals in retirement and greater investment flexibility. This can be a game changer when you need access to your funds. Ultimately, the best choice for you depends on your individual circumstances, such as your income, tax bracket, and risk tolerance. It's not a one-size-fits-all decision. It's always a good idea to consult with a qualified financial advisor to determine the best strategy for your specific needs. They can provide personalized advice and help you navigate the complexities of retirement planning. But no matter which path you choose, the most important thing is to start investing early and consistently. The earlier you begin, the more you can take advantage of compounding. The power of compound interest is real, and the sooner you start, the more time your money has to grow. This can make a significant difference in your retirement savings over the long term. So, what are your thoughts on the 401k versus Roth IRA debate? Share your experiences and questions in the comments below. We love hearing from you and learning about your financial journeys. And as always, thanks for watching, and don't forget to like, subscribe, and hit that notification bell for more financial tips to help you build wealth and achieve your financial goals. Your future self will thank you for the steps you take today.